Hi everyone, my name is Yong Boon and I'm someone who's quite interested in the global financial system and as well as things related to the global economy. So one question I've always pondered about is how did the international monetary system develop until what it is now, right? So from the very beginning until now, how did it develop? So I made a set of slides to present to you the development of the international monetary system from the 19th century until today. Here I have three images which shows you the key events that took place in the history of the international monetary system, such as the First World War, the Second World War, and when President Richard Nixon took the US off the gold standard in 1971. Right. So let's begin. So in this presentation, I've used two books as key references, as reference materials for preparing this content. They are Reform of the International Monetary System and Internationalization of the Renminbi by Li Ruogu, who is a prominent Chinese economist who was the chairman of the Export and Import Bank of China from 2005 to 2015, as well as a book titled The Exorbitant Privilege, The Rise and Fall of the Dollar and Future of the International Monetary System by an American economist, Barry Eichengreen. So these two books both provide unique and independent insights on the international monetary system and the history and development of this system. So if you're really interested after my presentation, do give these two books a read. So let's begin. So this chronological order was presented in the book by Lee, and it started off with the gold standard, followed by the gold exchange standard, and then the Bretton Woods system, and then finally the Jamaica system. So I'll be talking about these four systems in detail in the rest of this presentation, starting with the gold standard. Of course, before the gold standard, there were other monetary systems in use. Um, People start already used gold and other precious metals as currencies, as well as other things like commodities, like they did barter trading and so on. So but it was only in the late 19th century when many countries of the world came together, the major economies of the world came together and agreed on a particular standard, a particular standard that everyone would use, and that was only in the late 19th century. So for a detailed discussion of this in development, do refer to the book by Lee. So let's talk about the gold standard. As I said just now, even before the gold standard emerged in the late 19th century, gold and silver had been used by various European countries and the US from the 16th to 18th centuries. So in fact, the UK, right, Britain used to use the bimetallic standard, means gold and silver. But they realized that so essentially, gold and silver had a fixed exchange rate between them. A certain amount of gold could be exchanged for a certain amount of silver, and both of these metals were used as currencies in the British economy. So this was termed the bimetallic standard. But however, um, gold was the fact is that gold was is a metal that is much harder to extract from the ground compared to silver, and so it was more scarce. And so the price of gold relative to silver appreciated over time. It appreciated against silver. And so many um, households and economic agents in the British economy hoarded gold and only transacted in silver. And so this meant that, um, you know, after some time, silver was the only currency that was being used in the British economy. And so the system was inherently unstable for this reason, because gold inherently appreciated against silver. And so the bimetallic standard collapsed. And so in the 18th century, the British only used gold, right? And formally, they introduced the gold standard in 1844. And later on in the century, other countries like Japan, Russia, and Germany joined in as well and agreed to the gold standard. The gold standard is essentially a system of fixed exchange rates in which each country's currency was given a particular value in gold, right? So the British economy at the time was the largest in the entire world, and so you know they had the greatest say, right, in determining the rules of the monetary system, and so they pegged their currency as the had to have the largest value in gold, right? So I believe it was 113 grains of gold, 1 pound sterling, was worth 113 grains in gold, whereas the US dollar was worth around 22 and 20, between 22 and 24 grains of gold. So there was an exchange rate between the pound and the US dollar, right, of 1 pound being $4.86 US dollars. So because of the ratio of their worth in gold, right? So essentially, this was different countries would exchange their banknotes into gold or gold coins according to these ratios. Although we talk about it as a system of fixed exchange rates, there was some flexibility to allow for currency appreciation and depreciation against each other. So let's look at this mechanism as to how this thing works. If a country exports more than it imports and thus sustains a balance of payments surplus, gold would then have to be shipped from the importer countries who are probably going to be sustaining a deficit relative to it, right? And um, from these countries to this exporter country, and its currency would appreciate relative to other currencies. Naturally, this would cause uh, its exports to become more expensive in the currencies of the importer countries, and the quantity demanded for this country's exports would fall, right? And similarly, imports into it would become cheaper in its currency, and quantity demanded for its imports for imports into it would then increase, right? So well, the initial problem is that you're exporting more than you're importing, so you want to bring down exports and increase imports. And so uh, this adjustment mechanism does exactly that, right? So it brings down exports and increases imports, and so this would cause this surplus to be eroded or corrected. Similarly, the opposite is works as well. If a country imports more than exports and sustains a deficit, gold will have to be shipped to the exporter countries from it, right? And its currency will depreciate relative to other currencies. Its exports will become cheaper in other currencies, and the quantity demanded for the current country's exports will increase. And thus, and also at the same time, imports into it will also become more expensive in its own currency, and the quantity demanded for imports into it would decrease. And so the mechanism does, you know, increases in exports and brings down the level of imports, and thus again the deficit would be corrected. Of course, to keep the system stable, these exchange rate fluctuations are limited to within a certain range. Um, At this point in time, we have not brought in the role of central banks. So at that point in history, from 1880 to 1914, there were some central banks that were that were already set up, such as the Bank of England, and in some other European countries like France and Germany, I believe they also had some form of central banks. Only in the U.S. they did not have a central bank until 1913. In 1913, the Federal Reserve was set up, right, which is the central bank of the U.S. But it wasn't until then, which is basically 1 year before the gold standard collapsed, did the U.S. have a central bank. So a central bank did do a lot of perform a lot of actions to sort of maintain this standard. So they intervened in the money, the currency markets, right? So and this sort of hampered the self-correcting mechanism that we discussed in the previous slides. And so uh, the mechanisms that we discussed didn't work as well as they did, right? So a researcher, American researcher called Bloomfield, did a study of the monetary policy that were conducted by these central banks during the gold standard, right? And he published a paper on this in 1959. Yeah. So, yeah, as I mentioned in the last point, in practice, the mechanism was hampered by interventions of central banks as well as the presence of international lending and borrowing activities between countries. Yeah, so this mechanism didn't work as well as the people who theorized about these would have liked. And so another thing to keep in mind when we review this international monetary history is which economies were dominant at a point in time. And in the case of the gold standard, the first international monetary system, the British economy was the one who was dominant. Britain was the birthplace of the Industrial Revolution. It was the first to get industrialized, and then it became the world's largest economy for a large part of the 19th century. At the same time, London also became the financial capital of the world, and it essentially played the role that New York in America plays today, right? It was also the leading foreign investor, which makes sense because Britain was a large empire with many colonies around the world in Asia, right, and in Africa, right. So they needed to invest and in those colonies, and of course those investments will be made in pound sterling with their currency. At the same time, when they gave out loans to these colonies, those loans will also be denominated in its currency. At the same time, Britain also had the most developed financial markets, right? Because of course, it is the financial capital of the world, so it must have sufficiently developed financial markets, right, to trade various kinds of securities, right? It also had the Bank of England, so there was a central bank to do some intervention in currency markets where necessary, right? So yeah, all these factors point does do explain why you know the pound sterling, the current and was the leading currency at that point in time. And of course, the decline of the gold standard will also follow the decline of Britain, right? Um, So, although Britain was catapulted into prominence with the first industrial revolution, it was not able to adapt fast enough to the second one in the late 19th and early 20th century, which saw the invention of the light bulb by Thomas Edison, the alternating current electricity by Nikola Tesla, and the automobile by Ford. Right. So all of these inventions were were invented in the U.S. Right. So of course the Americans were able to capitalize on these innovations, right, and commercialize these things, and boost their own economic growth, right. So the U.S. and Germany as well grew rapidly during this period of time as they caught on with the deployment of these technologies. So some statistics for you to take a look at. From 1870 to 1913, Britain's share of global industrial output fell from 32 to 14%, while that of the US increased from 23 to 36%. There was this global economic reordering thing that took place during that time, where the US took the top spot, with Germany in the second, and Britain sliding down to the third place. And yeah, if you notice, 1914, the year the gold standard collapsed, was also on the eve of the First World War, during the start of the First World War. So during that time, the distribution of gold reserves around the world was severely unbalanced, and the basis of the currencies of member countries became undermined, right? Um, and large part of this is due to the fact that countries ramped up spending, right? So they essentially printed more money, they issued more money that the gold than they had in their gold reserves, right? And so uh, they could no longer allow free exchange between gold and the currencies, and many of these countries also prohibited the export of gold. And so essentially, right, all the rules of the gold standard were broken, and that also meant that the gold standard collapsed. Well, so on hindsight, was the gold standard a good thing or a bad thing? So let's evaluate the positive points. Well, the gold standard, in theory, did provide, and also in practice for a while, did provide exchange rate stability and made inflation rates predictable, right? So, of course, if your currencies are pegged to gold in a certain value of gold, then they are fixed, right? And this helped businesses to uh, perform calculations with ease. They are able to forecast into the future, right? How their costs and revenue would change, right? Because if these currency exchange rates are fixed, then it helps them to make these forecasts more accurately, right? And of course, this would facilitate international trade and help boost global economic growth. Um, and at the same time, because the money supply was tied to the supply of gold, because ideally, you cannot issue more currency than what you held in gold. Countries will not create excessive amounts of money, and so they won't overly stimulate demand, and so inflation will be controlled, right? So there was the positive. These are the positive attributes of the gold standard. But because of the fact that money supply was tied to the supply of gold, this is also a limitation and a key limitation mentioned by many economists, right, of the gold standard. So let's just consider this example of a fast-growing economy, right? It will need rapid money creation because to fuel a greater volume of transactions and economic activity within the economy. So by limiting the rate of money creation and extraction of gold or the accumulation of gold reserves, then you would artificially constrain economic growth within this economy with high potential for fast growth, right? So essentially, this standard did not allow for flexibility in the creation of money, and thus the rates of money creation did not match up to the rates of economic growth in most countries. And so that is the biggest limitation. This is the biggest limitation of the gold standard. After the gold standard fell apart, after World War II, countries wanted to return to a system of stable exchange rates. So remember, there was the gold exchange standard we presented on that slide, right? Gold exchange standard from 1925 to 1933. So 1925 is basically a few years after World War One, and 1933 also happens to be during the Great Depression. So countries wanted to return. So actually, this gold exchange standard didn't last a very long time. 1925 to 1933 is around 9 years, so it didn't really last a very long time. So countries want to return to a system of stable exchange rates to conduct normal activities again. So, but since then, since it was noted that gold supply was inadequate, right? As we mentioned, that being one of the key limitations of the gold standard, right? They turned to a pseudo gold standard, so something that resembled the gold standard, and they termed it the gold exchange standard. So under the standard, only the currencies of America, Britain, and France were convertible to gold. So it means other countries' currencies were not convertible directly to gold. This meant that for the Japanese yen, for example, to be converted to gold, it needed to be first exchanged for US dollars, pounds, or francs first, right? So these conditions that were put in place help to limit the purchase of gold from central banks, right? So in a sense, this is to tackle the fact that gold supply was inadequate, right? So in essence, the basic principles of the gold exchange standard were the same as that of the pre-war gold standard, and thus it suffered from the same flaws and limitations, and of course, so it didn't last very long. So the Great Depression, which took place around the world, right, most notably in the U.S. and Europe, right, led to numerous bank runs during which people lost confidence in the monetary system. So they went to exchange their banknotes to gold, right, or to in the case of the other countries, the non-US, non-France, non-British countries, they exchange it to the currencies of those that could be exchanged into gold, right? So to stop all the chaos, the countries then stopped free exchange again, and the system collapsed. Uh, Countries did gather to try to revive the system, but it didn't work, right? And essentially, what happened is that the monetary system actually split up into three regional systems. The U.S. Having one region, the French having one region, and the British having one region. So there was, and each region implemented their own capital controls, right? But the system was not very good. And shortly after that, there was World War II, and uh, yeah, there was World War II. Yes, and after World War II, or towards the end of World War II, rather, they came together again to discuss what should be the international monetary system after the war, right? And we do know that from the study of history, the U.S. Was essentially the victor, the only country to have emerged as the victor of the World War, right? And in a very good condition, right? They were in a very good economic shape. So, if I'm not wrong, American industrial output at the end of the World War II was around half or more than half of global industrial output at that time, and so. They had, of course, again, we note that the theme that the biggest economy at that point in time would have the biggest say in how things work around the world, right? So they could have the biggest say in determining the post-World War II global economic order. So again, the major economies held a conference this time in America, at a place called Bretton Woods, right? And so this conference was called the Bretton Woods Conference. And what emerged from those discussions was a dollar exchange standard, or the Bretton Woods standard. So what that meant is that the US dollar would become the international currency, and other currencies of other countries could be freely exchanged to dollars. But the only currency that could be exchanged for gold was the US dollar, right? So it was pegged at a price of $35 a pound, an ounce of gold. And of course, at the time, people were saying the dollar was indeed as good as gold. The US was extremely generous after World War II. It provided economic relief loans to Europe under the Marshall Plan, named after the Secretary of State at the time, George Marshall, and to Japan under the Dodge Plan. And Dodge was an American ambassador to Japan at the time. These were dollar-denominated loans, so they were essentially loans that were in dollars, right? US dollars, the international currency at the time. Um, and these loans allowed these countries to rebuild their economies, or rather, the aim of these loans was to allow these countries to rebuild their economies from the ruins of the war. And so, Europe and Japan accepted, right, the US dollar's hegemony at the time, because and wouldn't argue against the US, right, because they were the most powerful militarily as well, right? Um, and also because they wanted to focus on their domestic issues, right? Reviving their domestic and local economies, right? They knew that their currencies were not able to shoulder international responsibilities because their domestic economies were weak. So they didn't really want to fight against the US dollar. I mean, the US and the US dollar, right? They just accepted it, accepted the fact that they lost, and they needed help from the US to rebuild their own economies. And indeed, these relief loans did help these economies to get back on the track of economic growth, right? So they were able to register robust economic growth, right? In Germany and Japan in the 3 decades that followed the end of the war. And in fact, these two countries, Germany and Japan, soon became net exporters of goods to the world and even to the US. And this brings us to the next important issue called the Triflin Dilemma. So this is named after this person, American economist Robert Triflin, who argued, starting in 1947, even right, actually 3 years after the Bretton Woods system was set up, he saw that this Bretton Woods system, this dollar exchange standard, was essentially unsustainable in the long run. So he said the argument is that on the one hand, if the US is indeed the issuer of the reserve currency, of the international currency, the US dollar, and you know, to support global economic growth, it needs to supply dollars to the rest of the world, right? It needs to invest, it needs to loan dollars to the rest of the world. And this would mean that it would need to run persistent trade deficit. It needs to import goods and services from the rest of the world, right? It buys from Japan, it buys from Germany, and in the process, it returns to these countries dollars. So essentially, it's exporting US dollars currency to the rest of the world, right? This means that it needs to import more than exports, sustain a persistent trade deficit, and also to actively invest in these foreign economies. Right, but on the other hand, the US, being the issuer of the reserve currency, needs to maintain a stable value of the US dollar, right? And it cannot allow its foreign liabilities from exceeding its gold reserve. So it cannot issue more currencies than it does have in its gold reserves, right? And it cannot do this on a consistently, right? It cannot run persistent deficits. So because if they were to do so, if they were to issue more and more currencies, more than they can back up with gold, right, then it would mean that people will start to question: Does the dollar really have is the dollar really worth gold? Can I really exchange a US dollar into gold, right? So people will start losing confidence in the US dollar, right? So it would possibly lead to runs on its gold reserves. People will start to massively withdraw gold from the US central bank, right? Uh, all the other countries, whether it's in Europe or Japan, they would start to withdraw, exchange all their dollar holdings to gold, right? And that would not be good. And so they would undermine the value of the US dollar. severely. And of course, this problem didn't really emerge for the first part of the decade after World War II, but slowly this problem became more prominent in the 1960s. And this problem was so severe that President Richard Nixon had to announce to the rest of the world that US dollars were no longer convertible to gold as part of his new economic plan in 1971. So he said, and this plan was actually a very selfish plan, a US centered plan. He said it was to boost US economic growth, and this was at the expense of dollar devaluation, right? Remember, who are holding dollars? It was the other countries. So essentially, when the US devaluates the dollars unilaterally, everybody's holdings of US dollars will also be depreciated in value, right? Um, and of course, when he did this, there was also rampant inflation within the US and the rest of the world, right? So everything else remained the same. So it's just that you can no longer convert US dollars to gold, but other currencies could still be exchanged for US dollars. So everything else remained the same, right? Everyone thought the dollar has begun its secular decline, and other currencies such as the franc from France or the Deutschmark from uh, Germany would replace the US dollar, would rise to compete against it. But that is far from the truth. That was far from what happened in reality. Surprisingly, the dollar remained resilient. The US dollar's share of foreign exchange reserves at central banks around the world actually rose in the 1970s before declining towards the end of the decade. So you can see it hit almost 80%, right, in the middle of that decade, 1975. It hit almost 80% of foreign exchange reserves held at central banks around the world. So central banks around the world continued to hoard dollars as they needed dollars, US dollars, to intervene in their own currency markets to adjust the value of the national currencies. And no serious competitor emerged to rival the dollar. Neither the Deutschmark nor the franc, right, was capable of doing that. And so today, we have a system which we call which Lee calls the Jamaica system, right? 1976 to present, we have the Jamaica system, which is essentially a system of, or some people call a non-system because there are really aren't that many rules. It's just a free market of currencies, free exchange rates, freely floating exchange rates that are determined, the value of which is determined by demand and supply. So while the dollar has not declined and the share of central bank foreign reserves, as I show here from these graphs taken by a Bank of International Settlements working report, right, published in 2019, right, it shows that even at the end of 2017, um, uh, foreign exchange reserves denominated in US dollars still remains above 60%, right? But another thing to note is that the euro has also become regional currency in Europe, which makes sense because the European Union, within the European Union, they do a lot of trade with each other. So it makes sense for them to adopt a common currency, right? So the euro emerged, and this now accounts for around 20% of foreign exchange reserves. But when people look at this statistic which I present in this table below, they'll be quite rather surprised, perplexed even, that the today, right, the U.S. share of GDP, although the U.S. is still the largest economy in the world by nominal GDP, right, in U.S. dollars, right. Of course, China has already taken it on the PPP measure, right, but US is still the biggest, and China will eventually overtake only in the next decade, possibly the next decade, by the nominal GDP measure, right? But yeah, you can see here share of global GDP 25%, but share of foreign exchange reserves around the world 60%. So there's that mismatch there compared to the euro area having 15% of global GDP, but 20%. So it's a more proportionate to its economic size in the world compared to the US. So these are some of the references that I referred to in preparing this presentation. And as I mentioned, the books by Eichen Green and Lee are quite provide detailed accounts of the development of the international monetary system. And if you're interested in this topic, please do go buy these books or and read them. Yeah. All right, that's all for this presentation, and I hope you enjoyed it.